If you've been learning how to day trade for any length of time, you've probably heard the advice to stay on the right side of the market. Today, let's learn how. Hi everyone, I'm Jenks, this is The Trading Floor, and welcome to another episode of Back to Basics. Today's going to be part one of a little bit of a mini-series where I go over different ways to establish a daily bias. People employ varying levels of discretion when forming their daily bias, but today we're just going to go over a couple of very mechanical, rules-based strategies. Let's dive right in. First up on our list is Vwap. Vwap stands for Volume Weighted Average Price, and it's essentially a moving average that uses a formula that involves volume in its weighting. Let's put Vwap on the chart by going up to the indicators button and typing in Vwap. Now that we've added it to our chart, let's hop into the settings. To make things a little bit easier, let's turn off the upper and lower bands as well as the bands fill. For this example of forming a bias, we're just concerning ourselves with the Vwap itself. Now onto the inputs tab, you'll notice that instead of a length option like you may find on moving averages, you're going to find what's called the anchor period. This anchor period determines how much time is being incorporated into the Vwap calculation. Session is the default time, and it means the Vwap gets reset during the switchover between New York session and Tokyo session. The default Vwap is generally used by traders on the lower timeframes when they're looking for confirmation to match their higher timeframe perspective. For example, any given time during your trading session, if price is above the Vwap, the market is bullish and you should only be looking for buys. If you find price below the Vwap, that means the market is bearish and you would only be interested in sells. This is great if you're trading the lower time frames, as the Vwap essentially offers a look into what the entire day's worth of price has been working towards. Hopping back into the settings, I want to show you what it looks like to move this anchor period up to the weekly. The Vwap, when viewed through the weekly anchor period, offers an outlook that tends to hold more weight. Since the weekly Vwap resets weekly instead of daily, it's a bit more clear to see what the market's intentions are. In my opinion, the best way to use the Vwap to form your daily bias would be using the weekly Vwap to establish whether you want to be going long or short based on the higher time frames. Then when you go down to the lower time frames, wait till the session Vwap aligns with the weekly Vwap and then look to trade in that direction. Next on my list of easiest ways to form a bias is using exponential moving averages. Specifically, we're going to be using a pair of EMAs. Now, you can use any indicator you want to get multiple EMAs on your chart at once. My personal preference is this indicator called Ripster's EMA Clouds because they do a really good job at illustrating the EMA crossover. When you load it up, it's easy to get overwhelmed by the settings, but I promise it's actually incredibly easy. We're just going to scroll down to the bottom of the inputs tab and make sure that we're only showing EMA Cloud 1. Then we can scroll up and adjust the values on that EMA cloud. Go ahead and enter 10 for the short length and 20 for the long, then hit OK. Now, moving averages do not reset at the end of the day or week like the Vwap does. Instead, a moving average is the average price over a period length you choose. When forming the bias itself, the process is similar to what we did with the Vwap. When using the Vwap, we were looking for price to be above the Vwap for buying opportunities and for the price to be below the Vwap for selling opportunities. When using the moving average, we're looking at how they are stacked. For example, since we're using the 10 and 20 EMAs, when the 10 is above the 20, the market is bullish and we're going long. When the 10 is below the 20, the market is bearish and we're looking for shorts. I like using the Ripster EMA Clouds because they fill in the area between the EMAs, taking out all of the guesswork. As you can probably see, green for bullish, red for bearish. There is one final piece to this puzzle though, and that is once again using a higher time frame. This time we're going to use the daily. Up here on the daily, each individual candle is an entire day's worth of price action, so a 10 and 20 period moving average cloud is taking into account 10 and 20 days worth of price movements. That being said, once we understand how it all works, we're really just going to concern ourselves with what color the EMA cloud is. Again, red means we're in a bearish market and we're only looking for shorts. Green means we're in a bullish market and we're only interested in longs. Now, you can change the colors, but I think you get the point I'm trying to make. Now that you have the bias from the daily time frame, you can hop down to a lower time frame and look for your entry model that matches the bias's direction. Make sure you come back next time because I'll show you 2 free indicators that we built that can help you find bias even easier than Vwap and EMA clouds.